Congrats, you have $10,000. That's as much money as most people have saved for their entire lives so far. And you don't want to lose your pants on a bad investment, but you still want to make your money into more money. You've come to the right place. So first, let's talk about the most common way that people invest $10,000, and it's going to be through an index fund, mutual fund, or ETF. For the sake of simplicity, let's say that you're buying into a pie, and each pie is a certain theme, and that pie is divided into many different slices. Each slice is essentially a different ingredient, but they all have a common element. Here's an example with ICLN. So ICLN is an ETF that seeks to track clean energy investments. It's made up of a lot of different stocks, dozens of different stocks actually, but they're all related to clean energy. For example, you have Enphase, First Solar, DQ, all of these are stocks related to solar energy, for example. Now, there are subtle differences between mutual funds, index funds, and ETFs. For the purposes of this video, we're not going to cover that in depth. What I want you to take away from this is that with one investment, you could get into as many as 5, 10, 15, 20, heck, hundreds or thousands of different stocks all at once. This allows you to diversify your money. Even though it's $10,000, you still want to have some diversification. That way, you don't put all your money into one basket that suddenly gets crushed and destroyed by a monster. Now, for most people, funds are a great way to start investing. You don't have to worry about picking stocks. You're already buying into something that's diversified. You learn how to see the market movement, learn how to read company fundamentals, and then you start getting into it. But of course, a lot of people like stock picking. That's just the name of the game here. So I'm going to give you my own personal take on stocks to buy for your long-term investment portfolio if you're starting out with $10,000. Generally speaking, when you're young, you like to take more risk, and you can actually afford to take more risk. If you're investing for the next 20, 30 years, you don't have to worry about how the market's doing in the next 1, 2, 3, 4, 5 years, because eventually the market will bounce back. If you look at any 20-year period in the stock market, it's almost impossible that you have lost money that way if you did invest in diversified stocks. On the other hand, if you're about to retire, say in the next 3 years or 5 years, you definitely want to be careful about your investing, because if you get wrapped up into a bear market, say 2022, no one knows for sure exactly when the market will bounce back. And then in the meantime, you probably want to retire in those next 3 to 5 years. So if you get caught up in a stock that went down 70%, 80%, 90%, and you put a lot of your savings into that, then you're gonna look at a pretty nasty retirement. So understand that not all stocks are right for you. Not all investment advice or suggestions are right for every single person. That's why we don't say we offer financial advice. You should definitely talk to someone that's qualified to do so. But for the purposes of my video, most of my viewers are at that age where you can take a bit more risk. If you're in your 20s, 30s, or even early 40s, this might be something that you can consider. That's not to say we're gonna go all ape and get into some risky business here. We're still gonna take some precautions and some, smart risk management techniques here. So for my sample portfolio, I would suggest that everyone has a minimum of 3 to 5 stocks if you're starting with $10,000. Yes, a lot of people like to say, if you're only starting with $10,000, no point diversifying, just put it all in one stock. Well, that first of all, that teaches bad practices. It's not the right thing you want to do. When you have a larger portfolio, if you have $50,000, $100,000, are you still going to put it all in one stock? Like, it's going to teach you bad habits. So we don't want to do that. So 3 to 5 stocks, I think that's a pretty good diversified amount in each stock. So if you have 5 stocks, that's about $2,000 in each one. Okay. Next thing here, very important, is I think that everyone still should have some cash in their account. So even though we're a $10,000 investment portfolio here, 2,000 of that 10,000 is actually going to be cash on the side. This is great because it helps you survive mentally when the market is going down. You have some buffer. You have some money that you could put to work. Buy a discount, right? If everyone is, running out of a store because everything's on discount, that's kind of nonsense, right? When it's on sale, you want to do some buying, because we know the stock market in the long term, it's been around for 100 years, probably could be around for the next 100 years if we don't all die from a meteor or climate change or something, right? Probably the market will go up. So you do want to have some money when we have a rainy day. Next thing here is number 3. Don't put all your money in one area of the market, like tech stocks or all growth stocks. You don't want to do that because, again, diversification. So if a certain area of the market is not doing well, you want to make sure that you're not caught up in just that one area that's not doing well, because that could be really bad. It's uncomfortable. For some reason, that part of our economy might not do well for a long, long time. So it's good to just cover your bases in a lot of different areas. So if tech stocks are not doing well, maybe at least this other area is going to do well, like energy or healthcare is going to do well, right? So have some sort of balance here. And that leads into point number 4. Make sure you have some growth stocks and some value stocks. If you're a more aggressive investor in your 20s or 30s, for example, I would say put 75% into growth, 25% into value. But we're still gonna pick stocks that make sense and are actually profitable companies. So when I say growth, I'm not talking about, people think AMC or something, right? No. Or any of these Cathie Wood stocks, I would say be cautious with those, right? Stocks that are historically have been seen as high growth, but not profitable companies. They're burning billions of dollars a year. I mean, it might work out, but I wouldn't do that with your first $10,000. You know, that could go wrong very easily. And I don't want you to start out with some weird expectations that high growth stocks are going to always mean a lot of money. And then you get disappointed when they all go down 75%, right? Like last year. It's tough. When things are a bull market and people don't care about valuations, everything goes up. But for the purposes of this video, as a beginner, I want you guys to keep in mind of the good things that make a company grow in value, and usually that is being profitable on top of that revenue growth. And lastly, point number 5 ties into everything I said previously. Try not to buy penny stocks. I would say for your $10,000 here, don't buy penny stocks. Don't do it. No. Because these are extremely risky. I'm not talking about stocks that are literally 1 penny in value. They might be stocks under $5, and typically the market cap or the total value of the company is under $300 million. So a lot of the time you might see the term nano cap stock or micro cap stock. I would highly suggest to avoid those if you don't want to lose all of your money. I would wager that about 95% of all of those penny stocks will never do well in the long term. So that might be good if you want to throw some play money at it, but understand, that 5% is not a very good probability. And I want you to get into some high probability investments here. So let's get into my example portfolio right now. So the 5 stocks in my portfolio here, number 1 is going to be Perry, $2,000 invested into this one. This is an ad technology company. What I like about this one is that it's extremely versatile here in the sense that it fits as a growth stock and as a value stock. So Perry has, for the past few years, grown its revenue compound by about 30% annually. And its net income growth has also been very strong, over 100% every year. So in that sense, Perry stock is a high growth stock, but it's also a value stock, because if you look at the PE ratio, usually you want to pick stocks that are trading at or even below the market average. That tells you your stock, the valuation is below the average, so there's room for it to grow. That's an extremely elementary assessment of valuation. And for the purpose of this video, we're going to be okay with that. But there's a whole lot more that goes into deciding the value of a company. For now, that's a good beginner's barometer at looking at valuation. Number 2 is DE, Deere stock. This one is also in the value category. It trades at a PE ratio of 15, but I also see this as having potential for growth. This has historically grown 5-10% in revenue yearly, every single year. This has been a phenomenal investment in the long term for many, many investors. It's in agriculture technology and manufacturing equipment, but what I also like is that it has an artificial intelligence component with its autonomous tractors that could also be a growth catalyst for the stock in the future. So again, a growth and value stock here. Number 3 is actually an index fund, VOO. I think that as a beginner, it really doesn't hurt to put an index fund into your portfolio. It helps smooth out everything. An index fund, typically when it's diversified and it tracks something like the S&P 500, which is a good indication of how the overall stock market is doing, it usually doesn't drop or go up, all that much. It doesn't fluctuate as much. An individual stock could go up and down a lot, 30%, 50%, 100%, right? Hopefully not 100% to the downside, or else that would go to zero, but index funds may only go up and down 5%, 10%, 20%. So you don't have to worry too much about it. You just let it sit there and usually it accumulates wealth. You could see the overall long-term trend of VOO. Number 4 is really a wild card, but everyone's favorite, at least many beginners and millennials and Gen Zs, and that's going to be Tesla. Many people are big fans of Tesla for the growth and the long-term potential of electric vehicles, as well as their self-driving technology. They also have battery technology that they could license to other people as well and really change the game when it comes to energy storage. Tesla historically has been a very expensive stock with a PE ratio way above market average, or if you compare it to other automobile companies. So certainly not a value stock, but it has had consistent growth over the long term. Revenue growth has been 50% for many years, and net income growth has also risen from pretty much zero to making billions of dollars a year, especially as electric vehicles are currently still a very small percentage of the overall market share of new vehicles sold. That is expected to skyrocket by 2030. For the risk to reward, I would set about $1,000 aside for Tesla stock here. And stock number 5, NVIDIA. This is a semiconductor chip company. Its GPUs are used in a lot of different applications, from gaming to data center to autonomous vehicles. And recently, this has been the S&P 500 best performing stock in 2023. And this is my own personal, full disclosure, second largest position in my investment portfolio. And I'm really big on this one because I think that artificial intelligence will be a game changer. So similar to Tesla, this is a very high growth company. It is profitable, but it does have a high PE ratio. So if this one as well, I would suggest putting $1,000 into it in your first $10,000. Last but not least, as I mentioned, make sure you have $2,000 set aside in your investment portfolio to either average into these stocks, meaning continuing to gradually buy more and more shares of those companies, especially when there is a downturn in the market, or maybe you end up finding a different investment and then you get 6 stocks in your portfolio just to have a bit more diversification. So there you guys have it. That's how I would invest $10,000 in 2023 as a beginner to the stock market. With that sample investment portfolio, make sure you do your own research, and you also might want to discover some other ways to invest and some other stocks to play around with. But overall, I would say that if you're starting with $10,000, think in the long term and focus on your education rather than getting immediate returns. Good luck investing, guys. You're doing the right thing by trying to grow your money into more money. That's how everyone gets more wealthy. If you want to learn more about trading, make sure to check out our Stock Guys Premium Discord membership. We offer mentorship, live trading alerts, video courses, discussions, seminars, and a whole lot more. Subscribe to the channel and check out my other videos, and I'll see you in the next one. Take care.